Ever wondered how the bond market works? It's a fascinating cog in the global economic machine that often flies under the radar. Let's shed some light on it. Before moving forward, if you are new to our channel, don't forget to like and subscribe to our channel for future interesting videos. The bond market is like a bustling marketplace, teeming with governments and corporations looking to borrow money. They issue bonds, which are essentially IOUs, promising to pay back the borrowed amount with interest over a period of time. This brings us to interest rates, a key player in the bond market. These rates influence how much borrowers have to pay back and how much lenders can earn, making them a vital factor in the bond market's ebb and flow. Now, you might be wondering, how do bonds differ from stocks? Well, when you buy a bond, you're lending money. But when you buy a stock, you're buying a piece of ownership in a company. Think of the bond market like a global bank where governments and companies can borrow money. So, how does this global bank, the bond market, operate, you might ask? Well, let's delve into the mechanics of this fascinating financial landscape. Firstly, let's talk about the issuance of bonds. When governments, municipalities, or corporations need to raise funds, they issue bonds. This is akin to taking out a loan from the public. These entities promise to pay back the money plus interest over a specified period. This is the birth of a bond. Now, on to trading. Bonds are bought and sold in the secondary market, much like stocks. Investors buy bonds with the expectation that they will receive a steady stream of income in the form of interest payments. Alternatively, they may hope to sell the bond at a higher price than they paid. It's all about making a profit. But what determines these prices? Here we take a look at the principle of supply and demand. When there's a high demand for bonds, prices rise. Conversely, when there's an excess supply of bonds, prices fall. This dance between supply and demand shapes the bond market every day. And what about the role of economic factors? Well, these play a significant part in bond pricing. Inflation, economic growth, and geopolitical events can all influence investors' perceptions of risk and reward. For instance, during times of economic uncertainty, investors often flock to bonds as a safe haven investment, which can drive up prices. Lastly, let's touch on redemption. When a bond reaches its maturity date, the issuer must pay back the principal amount to the bondholder. This marks the end of the bond's life cycle. In essence, the bond market functions like an auction house, with bonds as the valuable artifacts being traded. And just like in an auction house, the dynamics of the bond market are influenced by a myriad of factors, from supply and demand to economic indicators. But that's what makes it such an exciting and pivotal part of our global economy. Not all bonds are created equal, so what types of bonds are there? Great question. Bonds come in a variety of flavors, each with its own unique characteristics, risk levels, and return potentials. First up, we have government bonds, also known as sovereign bonds. These are issued by national governments to fund public projects or manage the national debt. Often considered as some of the safest investments around, they offer lower returns compared to other types of bonds. For instance, U.S. Treasury bonds are backed by the full faith and credit of the U.S. government, making them almost risk-free. Next, let's talk about corporate bonds. These are issued by corporations to fund their business operations or expansion plans. Corporate bonds typically offer higher returns due to the higher risk involved. The risk level depends on the financial health and creditworthiness of the issuing corporation. So do your homework before investing in these. Now on to municipal bonds. These are issued by local governments or municipalities to fund public projects like schools, hospitals, or infrastructure. The unique selling point of municipal bonds? The interest earned is often exempt from federal taxes, and sometimes from state and local taxes too. However, like government bonds, they offer lower returns. And let's not forget about agency bonds. These are issued by government-sponsored entities like Freddie Mac or Fannie Mae. They are not fully guaranteed by the U.S. government, but they are considered to be quite safe with moderate returns. Lastly, we have junk bonds, also known as high-yield bonds. They offer the highest returns but come with a high risk. These are typically issued by companies with poor credit ratings. So, tread carefully with these. So as you can see, bonds are not a one-size-fits-all kind of investment. They come in different shapes, sizes, and risk levels. It's like picking the right ingredients for a recipe. you choose based on your taste and risk appetite. Choosing the right bond to invest in is like picking the right ingredients for a recipe. It all depends on your taste and risk appetite. Interest rates play a crucial role in the bond market, but how exactly? Let's start by understanding the relationship between bond prices and interest rates. There's an inverse relationship between the two. That is, when interest rates rise, bond prices fall, and when interest rates fall, bond prices rise. You may wonder why this happens. Well, it's all about the attractiveness of the bond in a changing market. Imagine this. You've purchased a bond that pays a fixed interest rate of 5%. Suddenly, the market interest rates rise to 6%. Now, new bonds being issued are offering a 6% return, making your 5% bond less attractive in comparison. Therefore, to entice a buyer, the price of your bond would need to drop. Conversely, if market interest rates fell to 4%, your bond with a 5% return becomes more attractive. As a result, more investors would want to buy your bond, driving its price up. So, how does a change in interest rates affect the value of existing bonds? When interest rates rise, the fixed interest payments of existing bonds become less attractive compared to new bonds, which offer higher rates. This leads to a decrease in the market price of existing bonds. On the other hand, when interest rates fall, new bonds come with lower interest payments. This makes existing bonds with higher fixed interest payments more attractive, causing an increase in their market price. It's important to note that long-term bonds are more sensitive to interest rate changes than short-term bonds. This is because investors may be unwilling to lock their money into a low-return bond for a long period when they can possibly get higher returns on new bonds in the near future. Interest rates and bond prices are like two dancers in a tango. When one moves, the other follows. So, as an investor, it's crucial to keep a close eye on interest rate trends to make informed decisions in the bond market. Every investment carries some risk, but what are the risks and rewards in the bond market? Let's first delve into the risks. The most prevalent one is interest rate risk. When interest rates rise, the price of existing bonds falls. This inverse relationship is a fundamental tenet of the bond market. If you plan to sell a bond before its maturity, you might have to do so at a discount if interest rates have risen since you bought it. Next, let's consider credit risk. This is the danger that the entity issuing the bond will default, meaning they will fail to make their promised interest payments or to return your principal when the bond matures. Bond rating agencies like Moody's and Standard & Poor's assess and rate the creditworthiness of bond issuers to help investors gauge this risk. Then there's inflation risk. If inflation outpaces the interest rate you're earning on a bond, your purchasing power could diminish over time. This risk is particularly pertinent for long-term bonds. Now let's pivot to the potential rewards. One of the primary attractions of bond investing is the promise of regular income. Bonds typically pay interest semi-annually, providing a steady cash flow. This feature makes them particularly appealing to retirees and others who require consistent income. Capital preservation is another significant reward. When a bond is held to maturity, the investor can expect to receive the face value of the bond back, barring a default by the issuer. This makes bonds a popular choice for conservative investors seeking to preserve their capital. Lastly, there's the potential for capital gains. If interest rates fall after you've purchased a bond, its price will rise, and you could sell it for a profit. While this isn't the primary reason most people invest in bonds, it's a nice potential bonus. Investing in bonds is a balancing act between risk and reward. The key is to understand these dynamics and make informed decisions that align with your investment goals and risk tolerance. To sum up, the bond market is a complex yet fascinating world. From our discussion, we've seen that it's a vibrant, multifaceted market that plays a vital role in global finance. Let's take a moment to recap. We began by exploring the operation of the bond market. It's a place where issuers, like governments and corporations, raise capital by selling bonds to investors. These bonds are essentially IOUs, promising to repay the principal amount along with interest over a specified period. This mechanism allows the bond market to offer a channel for savers to lend their money to borrowers who need it, facilitating economic growth and development. Next, we dove into the different types of bonds available. Government bonds, corporate bonds, municipal bonds, and more, each with their unique characteristics and risk profiles. Government bonds, often considered the most secure, are backed by the full faith and credit of a nation's government. Corporate bonds, on the other hand, offer higher yields but come with a higher risk of default. Understanding these differences is crucial in building a diversified bond portfolio that aligns with your investment goals and risk tolerance. We then turned our attention to the role of interest rates in the bond market. As we discussed, interest rates are the heartbeat of the bond market. They influence the price of bonds, the yield, and ultimately the return on investment. When interest rates rise, bond prices fall, and vice versa. This inverse relationship is a fundamental concept in bond investing. Our discussion wouldn't be complete without addressing the risks and rewards associated with bond investing. Bonds are often touted as safer investments compared to stocks, but they are not without risks. Interest rate risk, credit risk, and inflation risk are some of the key considerations. On the flip side, bonds offer regular income through interest payments, preservation of capital, and diversification benefits. Balancing these risks and rewards is an essential aspect of successful bond investing. As we wrap up, we encourage you to delve deeper into the bond market. It's an intricate tapestry that requires careful study and understanding, and while this video provides a solid foundation, there's so much more to learn. Consider seeking professional advice before making any significant investment decisions. An experienced financial advisor can help you navigate the bond market and align your investment strategy with your financial goals. In conclusion, the bond market is a vast, dynamic entity that offers a myriad of investment opportunities. It's a market where governments and corporations meet savers and investors, a market that influences economies and shapes the financial landscape. And as we've outlined, understanding its workings, the types of bonds, the role of interest rates, and the risks and rewards can provide you with the tools to make informed investment decisions. Remember, understanding the bond market is the first step towards making informed investment decisions. So here's to your journey into the world of bonds. May it be an enlightening and rewarding one. If you enjoyed this video, don't forget to like and subscribe to our channel. Thanks for watching.